Selling pressure remains in the equities market as a result of central banks' aggressive tightening. Our next guest believes it could be time to return to the bond market. Joining us now is Avi Hooper, Senior Fixed Income Portfolio Manager at Invesco. He joins us right now. Avi, thanks a lot for joining us. You say in some recent commentary that fixed income valuations have not been this attractive since the 2008 great financial crisis. Why so?
Well, that's right. I mean, the way we're thinking about the current economic cycle, in fact, it's 14 years long in the tooth. It, in fact, we believe started at the time of after the global financial crisis. So when we look and fast forward to where we are today, we see valuations just as they are, that attractive at the end of the economic cycle when, not surprisingly, markets become very focused, very unilaterally on things like inflation.
And what about the notion, we just had a conversation with a Bloomberg analyst on this subject. If we get evidence later this week that inflation has peaked in the U.S., how will markets respond?
Well, again, because of this backdrop with, we believe, very attractive fixed income valuations, a downside surprise or a peak in inflation would be very supportive for fixed income in our view. Keep in mind when we talk about this pure focus on inflation, in our view, what the market and overall financial markets seem to be ignoring is a very significant deceleration in economic activity globally.
You're seeing value as well in corporate debt. You say that you see a lot of high quality issues that are working to pay down their debt, thus their balance sheet and their prospects for repaying existing debt, making good on bond obligations looks good.
Well, that's right. The way to think also about inflation is who has pricing power. And companies or corporate debt markets have been very buoyant. It's allowed these companies to refinance their debt obligations at very low levels of nominal yields, of very low levels of cost of capital. And so when we look forward, we actually see that when you look at the three sectors of the overall economy, households, government, and corporates, it's actually companies that probably have the least amount of financing risks going forward.
The theme that we've mentioned is particularly present in the Canadian energy sector. We've seen a lot of focus there among big energy producers with these high oil prices using their excess cash flow, free cash flow, to pay down debt. Do you see that elsewhere in the commodity sector or in other sectors?
Well, certainly the energy's really stood out. But keep in mind what's happening in the background within the energy space. Oil prices are rising. This is clearly very fundamentally supportive for these energy companies. But what they're not doing and what we had seen in the past is investment. We are not seeing new investment. So that's the big difference why energy, in our view, really stands out from a debt perspective. These companies are seeing tremendous amount of free cash flow. They're in a great position to pay down debt, because there are no plans to invest, right? The broader theme of renewable energy and, if anything, maybe a bit of a fast forward too quickly away from traditional fossil fuels.
What do you continue? Do you believe that the current yield action is something that will be extended as the equity markets sell off?
Well, this has been the non-normal state of current market conditions, right? You would typically expect tremendous amount of diversification from your fixed income. But in fact, given the broader uncertainty at this time in the global economy, the correlation or the relationship between all asset classes is moving in a uniform direction. This, as I say, is non-normal. And that's another reason why fixed income, in our view, in an outlook of a slowing economy with the potential of peak inflation behind us, again, fixed income to us looks very attractive.
What about, you mentioned a slowing economy. The most negative scenario in a slowing economy is an economy that actually contracts, actually hits recessionary conditions for a period of time. An earlier guest on our station this morning believes he says he does believe the U.S. economy is headed to a recession, perhaps a fairly shallow and short one, but a recession nonetheless. Your view on the future path of the U.S. economy, is it headed to a recession?
Well, whether we look at the U.S. and, of course, Canada is very dependent in terms of cyclical perspective on what happens in the U.S. economy. I mean, can you imagine if you or I were driving at 100 kilometers an hour and all of a sudden we had to slam on the brakes? That's what's happening today. Our economy is still running very, very quickly, far too quickly. But central banks have decided to literally slam on the brakes. We're skidding. The likelihood of a recession doesn't seem extremely high in the near term, but as we move into the second half of this year and into 2023, the prospects for recession do look reasonably high in our view.
Avi, thanks a great deal. That was Avi Hooper, Senior Fixed Income Portfolio Manager at Invesco. He joined us from St. Catharines.